You know what's crazier than a flat white costing $8? The idea that the New Zealand housing market is still totally fine. Today, a reality check on real estate with ANZ economist Henry Russell.
Financial freedom faster. Financial freedom faster.
If you like making money rather than watching everyone else do it, hit that subscribe button and get ahead, because this is New Zealand's fastest growing real estate and investment show. Latest GDP figures show growth of 0.7%, surpassing expectations and marking an exit from recession. But Henry, is the recovery real?
The recovery certainly is real, but it is important to remember that we're coming off a 6-month period where the economy went 2% or more than 2% backwards. And so that is going to take time to unwind. In terms of when that's reflected in hard economic outcomes for households and businesses, it is still going to be some months before we see that.
So is it a little bit of smoke and mirrors and we're just kind of waiting and seeing now for the next quarter's result, or?
Yeah, well, the challenge with the GDP data at the moment is, to be frank, it's all over the show. So it can be really challenging to diagnose the signal from the noise in these data. And actually, if you want to get a little bit technical, so to do with how Stats New Zealand seasonally adjust the data and the like. And so, look, that's not to say that it's all make-believe growth. We were actually surprised underlying momentum in the economy was a bit better than we expected. But again, when you're coming off, the worst 6 months of economic performance going back to the early 90s, that does take time to unwind.
Are we in a property bubble? How does this GDP data take into account the housing market?
Well, actually, some of the details did show, what we've been seeing in the property market recently, that it is starting to warm up and that activity is lifting. So broadly, the housing market is recovering. I certainly wouldn't say it's a vigorous recovery, but we are starting to see signs that house prices are moving higher. But of course, it's going to take time until we see a more meaningful upswing, given that there is a lot of stock currently on the market.
Yeah, I was reading the ANZ February report, and I saw you described it as that 2021 growth, that we couldn't keep up with it, and it was like pulling muscles and popping a lung.
Yeah, 2021 was a completely different story for the economy. Unsustainably low interest rates and enormous monetary and fiscal stimulus. And of course, that boosted the housing market. House prices rose nearly 50% or so. And in the early stage of the pandemic, we've obviously paid the cost for that over, recent years with a pretty decent pullback in house prices. But I think it is, there's been a lot of talk about, the housing market picking up and house prices lifting. Even our forecast of a 6% rise in house prices over 2025, I certainly wouldn't characterize that as a super strong market. It's simply consistent with the recovery coming off a couple of years of very subdued activity.
Just a reminder, your competition has already subscribed to the fastest growing property and investment channel in New Zealand. That means they're getting the insights first, making the moves first, and locking in profits while you're still debating whether to click a button. Be smart, subscribe. So the Reserve Bank is playing with interest rates again. We're seeing a bit of a rate cut roulette. There's still a lot of uncertainty with what economists predict to go on, but you guys are maintaining that it'll keep dropping steadily towards 3%?
Yeah, I think 3% is a good benchmark at the moment for where we will end up. So, that's what economists consider to be the neutral level of the OCR. So by that, it's kind of like the Goldilocks level. It's neither stimulatory or it's neither restrictive. So, there's a lot of uncertainty about where that is. And of course, the Reserve Bank's own estimate has the OCR, the neutral OCR, anywhere between 2.5% and 3.5%. It's certainly not something that you could observe, at least in real time. But look, there's nothing to change the Reserve Bank from continuing to pursue its, that current strategy of getting back to a neutral setting. The GDP data that we saw certainly isn't a game changer and doesn't have material implications for the outlook. What we're seeing at the moment is that a recovery is underway. And there is a lot of scope for the economy to grow. In fact, grow pretty strongly over, the coming quarters, and for that not to have, significant inflationary consequences. The Reserve Bank shouldn't be concerned about growth at the moment, given that the economy is operating with a lot of spare capacity. The GDP data we saw certainly is consistent with domestic disinflation continuing to slow back to that level that's consistent with inflation at target.
Inflation still seems to be a little bit of a pain. And certainly, inflation used to be a little bit more predictable, and now with the technology causing deflation, like, how are you guys staying on top of this inflation metric, and how is it impacting the GDP side of things?
I think the first point to make on inflation, if you think about where we are today, annual inflation is running pretty much bang on the Reserve Bank's 2% target midpoint. It's at 2.2% currently, but so people might think from that the job is done, but for the person on the street, it doesn't take into account that the level of prices has risen dramatically over recent years. And so, that's the story of consumers' purchasing power being eroded. In terms of what we think about the outlook from here, look, there's plenty of uncertainty. I think the most important thing to focus on, and certainly what the Reserve Bank will be focusing on, is whether that underlying domestic inflation pulse continues to slow. So historically, to have headline inflation at 2%, consistent with the target, domestic inflation needs to be running around 3% or slightly above, and we're still at 4.5% today. That doesn't mean that the trajectory is certainly still encouraging. We do think we will get back to that point over time, but the challenge for the Reserve Bank is all the other stuff that they can't control. So tradable inflation, for example, which is the largely imported component of inflation. Obviously, the global economy is navigating a pretty challenging period at the moment with the uncertainty over tariffs and, the potential for a global trade war. The New Zealand dollar has done its job and has adjusted lower, and that's an important buffer for the economy. But of course, that does carry the risk that it stokes inflation pressures, given that it increases the cost of the things that we import. But there's plenty of scope at the moment, we think, for the Reserve Bank to look through some of the noise with inflation. I mean, on our own forecast, we actually have inflation rising over the coming quarters and peaking at about 2.7% in the September quarter of this year. So that's obviously going the wrong way, but the reason the Reserve Bank has a target band, 1 to 3%, is so that it can look through some of these temporary noise factors. So the inflation coming through from a lower exchange rate or some of the global volatility doesn't tend to stick around so long. And so there is scope at the moment for the Reserve Bank to kind of, look through that and ultimately focus on the medium-term outlook, which is still looking encouraging that we will get back to, a low and stable inflation environment.
Yeah, we did have a little bit of an inflation inferno for a few years, and I guess that hasn't really eased. There's still embers there. When you add in the wage woes we've got, people are not getting paid as much as they would like, and they can't afford the day-to-day things. How is this impacting the velocity of money? Is consumer spending, has it slowed way down, and does it need to pick back up for the economy to keep getting better?
Absolutely, it does. And yes, it has slowed. It did slow down at least last year, but we are seeing signs that a recovery is underway. Card spending data has been trending higher for some months now. But consumer spending is a really important part of the economy. Over 60% consumption is over 60% of the economy, of course. So it is a really important driver of growth. But part of the reason we think this recovery is going to be gradual at first is because the labour market is still adjusting to past weakness in the economy. So if you think about it from a business's perspective, once they see a drop in sales, their first port of call isn't to fire their staff. That's, an incredibly challenging decision for them to make. And that's part of the reason why, the labour market and, the unemployment rate tend to lag the broader economy. And so there is still a little bit of weakness still to be seen in the labour market. I mean, on our own forecast, we have the unemployment rate rising from the 5.1% level it is today to 5.3% over the first half of this year. So most of the adjustment has been made. But importantly and encouragingly, we have seen some positive signs over recent months that jobs growth is returning. So Stats New Zealand releases a monthly filled jobs indicator, and that grew fairly strongly in the last read in January, and it's certainly suggesting that, you know, the early signs of a labour market stabilisation are here. But again, these things do take time to wash through, and so when we think about what this means for the recovery in the economy, you know, when New Zealanders start feeling that things are getting better, it's probably going to be a story for the second half of this year once that labour market adjustment has been finished or completed.
And it seems like the big shock story part of this GDP announcement was that tourism is bouncing back.
Yeah, I mean, New Zealand's external sector broadly is playing a really important role in the recovery at the moment. But as you mentioned, international visitor arrivals have picked up. Now, that was a little bit of a surprise in the sense that, you know, we track overseas visitor arrivals into the country, and you know, they recovered to around 85% of pre-COVID levels back in May 2023, and then it stagnated for about a year. So we've actually lifted above 90%, and look, that's a really positive thing. And you know, that's part of the reason that for those who are living in the regions closely tied to tourism, they're probably feeling a little bit more optimistic than some of those in other cities, particularly Wellington. But it's actually not just a tourism story. Our primary production, you know, primary sectors doing very well at the moment, particularly dairy and meat. Our export prices are high, supported by a lower New Zealand dollar. So that's the flip side. Obviously, the consumer might face higher prices for those imported goods, but it's a boon for our export sector in that it improves their competitiveness. So the rural sector is certainly a really, you know, really good story for the economy at the moment, and really important part of the recovery we're seeing.
Yeah, there's some fantastic graphs and forecasts in the ANZ February report that was released before this GDP data, but I found that quite helpful. Henry Russell, ANZ Economist, thanks for joining us, and we'll talk again sometime soon.
Thanks for having me on.
Just a reminder, money moves fast and the investors making the most of it are here. This is the fastest growing property channel in New Zealand for a reason. If you don't subscribe now, just know that someone else is already using this knowledge to make their next deal while you hesitate.
More cash, passive income coming fast. Make your money work for you. Live the dream, it's overdue. So don't just wait, take control. Mortgage HQ will make you bold. Financial